So division 3, smart money versus dumb money. So I'm going to begin with some statistics. So the first statistics I'm going to mention is that 95% of retail traders are losing. Their portfolios are in a net loss. Now, if we would try to make sense out of this, right? Let's just try and make sense out of this statistic. Let's just say you approach the markets from a standpoint that you are going to flip a coin whenever you execute a trade. So whenever you execute a trade, you're going to flip a coin. So long or short, that's completely random. Stop loss take profit, you flip a coin for both of these. Those are completely random values. If you were to do that from a probabilistic standpoint, after spreads, commissions, and slippage, etc., you should be slightly, your P&L is going to be fluctuating around break even, but it's going to be leaning towards the negative because of commissions, spreads, and slippage. But it's only going to be slightly negative. It's not going to be like tremendously negative. But this could excuse a lot of the losers, but it cannot excuse 95% of losers, especially when you think that these people are people who are trying very hard to be profitable. There are people who are applying a strategy. There are people who are trying to make money. You know, they're not coming in with the mindset that they want to lose their money. They're coming in with the mindset that they want to make money. So how come when they apply these things, they become so unprofitable? How come it's so easy for someone to completely blow an account, but it's 10 times as hard to double their account? How does that make sense, right? Make it make sense. Because if it was completely random, like it's as if you went to a test, to an exam, to a quiz, where you can, each question has 2 options, and you would consistently, without knowing anything, you would consistently fill in the wrong square. How do you know to fill in the wrong square? There has to be a degree of manipulation for you to do that. It either has to be deliberate from your end, or someone else has to lead you to that decision. Because it cannot be random. If it was random, then the statistics would reflect that, but they don't. They reflect that it is extremely to one end. That is the equivalent of the statistics we're seeing in these markets, which proves to us that there's some type of manipulation going on. Whether you like it or not, that's a fact. Now, let's go over to the next talking point. So, the gap between winners and losers. Take a market. Let's just say there's some people who win consistently and there's some people who lose consistently. We know that to be true because we know that there are consistent traders who consistently win and there's consistent traders who consistently lose. Take that process of you consistently losing or consistently winning, a group of people consistently winning versus a group of people consistently losing. Take that and spread that over 5, 6, 7, 8, 10, 20 years. The longer it goes on for, the richer the winners become and the poorer the losers become. It is for the simple reason that winners take money from the losers and losers give money to the winners. So as a consequence of that, there's a perpetually growing gap between winners and losers. The winners are consistently taking money from the losers, and the losers are consistently giving money to the winners, which means the winners become extremely wealthy while the losers become extremely poor. But wait. So the winners are very rich and the losers are very poor across a very long period of time. What does this mean for us? Well, remember what I said earlier, that there's 2 sides to every transaction, right? There's winners and there's losers to every transaction. There is an equal volume on both ends. Equal volume on both ends, okay? So if this end has $500,000 volume, then this end is going to have $500,000 volume. If $500,000 were lost on this end, then $500,000 were gained on this end. This means that the rich winners are responsible for an equal volume as the poor losers. How does this make sense? The only way it could make sense is if there's a small group of winners and a large group of losers contributing to that pool, which creates the volume. So this proves to us that there is an elite group of people who are consistently taking money from all of the losers. There is an elite group of people who are consistently taking money from all of the losers. Now, the only way this would make sense is if they are manipulating price. Now, let's take a scenario real quick. Let's try and think of a scenario. Like, some people bring up the theory that the elites might not be all on the same group together. Let's take a scenario real quick, just so that we can understand this better from their point of view, okay? Let's just say there is one guy who's the richest player in this game, has $1 trillion. There's another guy below him who has $200 billion, another guy below him who has $100 billion, and so forth and so forth. Now, let's just say the guy with $200 billion thinks, okay, I have a lot of money, more than the daily traded volume of this asset. I can definitely manipulate this price. And he tries to bring the price down. So he goes ahead and he facilitates all of the longers below him. He just shorts and shorts and shorts into shorts. He's exhausting all of the longers to move price down. Now, he thinks it's going to move price down because that's how it's supposed to be. Now, this $1 trillion guy sees an opportunity. He sees, okay, there's somebody who's shorting the markets with a large volume of money. And he thinks, and this $1 trillion guy thinks, okay, I probably have more money than this guy. So what he'll do is he will facilitate all of his shorts. So he will offer longs to every single short position that this guy sends into the markets. Now, this will continue. So this guy will add more shorts and this guy will add more longs until one of them runs out of money. Now, the person who's going to run out of money first is going to be the guy with $200 billion. He's going to run out of money. And what happens when he runs out of money is the $1 trillion guy is going to be left with $800 billion more, which he can use to manipulate price. So now at this point, all he has to do is manipulate price up. And now the $200 billion guy is going to be underwater in his shorts, and he's going to have to find a way to liquidate them. And when he liquidates them, the richer player, the $1 trillion guy, is going to take him up on the offer, and he's going to essentially realize his positions through him. And that's how the $200 billion guy is going to lose his money, and the $1 trillion guy will take his money from him. Now, all the wealthy players are aware that this is exactly what would happen if they made an attempt at manipulating the market against all the other big players. So instead, the only way as a wealthy player you can participate in the markets as a ultra wealthy player is, I'm talking ultra wealthy, like billions and billions and billions of dollars, is to be part of their gang. So if anyone who's not part of their gang is just gonna lose. Whenever he tries to manipulate the markets, they're gonna go against him, because why not? They would want to make money. He would lose money and he would get burned. So it's either you join or you can't do anything. Okay? Or your money is useless. So up until this point, was I clear? Do you guys have any questions? I'm gonna give you like 30 seconds for questions. Does anyone have any questions, or have you guys been following? Okay, what I'm trying to say is money is power, and the most coordinated group of power is the one that's going to have the strongest punch, pretty much. So let's just say trading is a zero-sum game, but let's just say there's all of the money, and all of the money collectively probably has more money than these elites. But the thing is about the money is that they're not coordinated. They are each man separate. And because they're not coordinated, they can't manipulate the markets, because if they'll try, if they, let's just say the money puts down $1 billion of short volume, this elite guy is going to see an opportunity to capitalize on to go long with $1 billion, and he's going to make these guys lose because they're going to run out of money. If the money was coordinated, then it would be possible, theoretically, but it would be statistically impossible, probabilistically impossible for that many people to coordinate. So that is why they can't do anything about it. Now, let's continue. So how the elites manipulate price. Wait, okay, let me just read real quick. So quick question, these are generic concepts, right? They would apply in the future. Yes, these concepts would apply in the futures markets as well. Well, no, what I'm saying is there is no war between these large institutions, because if there was, it would end so quickly, because this guy is going to get burned instantly. Anyone who tries to go against the stronger guys is instantly going to get burned if you're going against them with a large amount of money. So if I was now to go in the markets, let's just say I have a time machine. Price went up from December 1st to December 2nd, price went up. If I go back to December 1st and I go to December 1st and I long with $50 billion, price is not going to go up from December 1st to December 2nd. It's going to go down. Why? Because these elites are going to see, okay, there is an opportunity for us to go short with $50 billion against this guy, and then use our large sums of money to manipulate price down in case he tries to buy more longs. Okay? So if I were to go back to December 1st and long it with, say, $1 million, then it probably wouldn't make a difference. But with large sums of money, then it's going to make a difference. Okay? Okay, we're going to continue now. So how do these elites manipulate price through supply and demand? So first off, we must understand supply and demand as if it was not manipulated, and then we will explain it as it is in reality. So in a perfect world, or actually in a natural market, in a market that's not manipulated, this is how supply and demand is. Imagine there are 10 shelves for apples in the local market. There is a shelf for $1 apples, $2 apples, $3 apples, all the way up to $10 apples. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And there's supply at every bench. Right now, as a seller, you'd naturally be more inclined to put your apples, list them for $10, because that's the higher price. But if you put your apples at $10, there's likely going to be someone else who will list them for $9. And then the buyers will prefer to buy from him and not from you. So the competition between sellers brings the price down. So now let's just say there are some sellers who are willing to sell it for $1. Not many, there's very few. There's a bit more sellers who are willing to sell it for $2. There's a bit more who are willing to sell it for $3. There's a bit more who are willing to sell it for $4. And then everyone is looking to sell it for $5 to $10. Okay. Now, the bell rings. The market has begun, and the buyers are coming in. Now, all the $1 apples instantly gone. Boom! Price moved from $1. Now the next apple is going to be sold for $2. Boom! People start buying the $2 apples. Now the price is currently at $2 because people are supply and demand is agreeing at $2. Boom, supply is out at $2. Now there's supply at $3. Buyers are buying that out. Now $3 supply is gone. Now $4 supply. Some people want to buy it. Some people don't want to buy it. At $4, price stopped moving up because the demand wasn't willing to match any price higher than $4. This means that the orders to sell apples between $5 and $10 were all left behind. That is how supply and demand works Technically, that's the technical aspect of it, and that's how it works. Now, what happens in reality in these markets, right? So what happens in these markets is much the same, except the supply and demand in the markets is 100% money. Wait, before I move on to this, I just want to make sure everybody understood and that was clear. Was I clear, everyone? Let me know if you understood what I said. Okay. Okay. Okay, so I'm seeing some requests to go over again, so I'm going to go over one more time. Imagine there are 10 shelves for apples. Each shelf represents a different price. Okay, these are like the books in the markets. There's limits. There's a shelf for sell limits. There's a shelf for buy limits. Okay, so let's just say in this market, there's only sell limits and the buyers coming from the markets. Okay, so you have shelf $1, shelf $2, shelf $3, all the way up to $10. Each shelf represents a different price. Sellers overnight, before the market opens in the morning, they're going to put their stock, they're going to list it for sale on these shelves. So they're going to list apples for $1. They're going to list apples for $2. They're going to list apples for $3. Obviously, as sellers, they would prefer to sell for the highest price possible. But if they list it at $10, there's a very low likelihood that there's going to be any demand at $10, considering these buyers can just buy it from some other seller who's selling for a lower price. So the competition between sellers brings price down to the lowest, fairest price that the sellers can offer to the buyers. Now, the competition between buyers brings price up to the point where it's fairest, fairest to the point it's fair. So if, let's just say, $1 apples are extremely cheap and all the buyers want that, that's going to be sold out instantly. $2, that's everyone wants that. That's going to be sold out instantly. $3, everyone wants that. That's going to be sold out instantly. But $4 is the sweet spot between buyers and sellers. And that's likely going to be the price that the price where, well, the price tag, which price fluctuates around. So the market opens, $1 apples instantly sold out, $2 apples instantly sold out. Now price is trading at $3. $3 apples sold out. Now the next sale price will be trading at $4. Now $4, the stock there is some demand, but it's not getting sold out completely. But there's also no supply at 3, 2, and 1, so price is not going to go down, and that's why price stays at 4. Okay, this is how supply and demand works. Now, on to the next. On to how it is in reality. So now, in reality, what happens in these markets, is pretty much like this. So I'm going to take a sip of my coffee first, and then I'm going to explain it. In these markets, supply is short contracts, and demand is long contracts. That is how price is booked. It's booked based off the exchange rate between longs and shorts, supply and demand. Okay. Now, longs and shorts in reality are money. It's simply money. Money buys you longs and money buys you shorts. Right? So now what this means is that if you have enough money, you can manipulate price completely and utterly. Let's draw for you guys a scenario. Okay, I'm gonna annotate for you guys a scenario. So here. Okay, so so let's just imagine wherever I put this, that's a limit. So price is currently over here. Okay, so I'm gonna do it like this. So price is currently over here. Okay, here's where price is at. Now, here we have some buy limits. Wherever I do waves, it's buy limits, okay? Here we have buy limits. Here we have sell limits. And price is currently over here. If And now let's just say this is the price of $3. This is $5, and here is $4, $2. So price is currently at 3. The nearest buyer is at 2, and the nearest seller is at 5. So the nearest long is at 2, and the nearest short on the books is at 5. This means that if I were now to buy one long, my long would have to be facilitated. It would have to be paired with a short, right? So where is that nearest short? That's at $5. So the spread is going to be $2. It's going to go instantly from 3 up to 5. Price is now going to be at 5. And now from here, the nearest long limit is down at 2. So now if I were to enter one short position, then price would instantly drop down to 2, right? Because the nearest, if I go short, it has to be paired with a long, and the nearest long is down here. So price would have to drop over here, and there's going to be a spread of 3, right? Between 5 and 2, there's a $3 spread. This is how price moves in these markets. Now, how can this process be manipulated? Well, let's just say I want to move price up in these markets. Okay, now let's just draw out a graph. So here is the price of 0. Here is the price of 1, 2, and 3. Okay, so now let's just say price is currently trading at 0.5, or let's just say it's currently trading at 1. Okay, so price is currently trading at 1. Now let's just say I want to move price up to $5 or to $3. So let's just say I want to move price up to $3. If I want to move price up to $3, the way I'm going to have to do that is I'm going to have to buy out all of the limits until $3. So there's going to be supply. I'm going to have to buy out all of the supply until $3. So there's going to be supply over here. There's going to be supply at $2. There's going to be supply over here. I'm going to have to facilitate all of this supply, all of these shorts. I'm going to have to facilitate them by offering them longs. So let's just say there is $5 billion of volume of supply, between 1 and 3. I'm going to have to use up $5 billion of capital to bring price up to 3. So I'm going to have to, if I want to bring price up to 3, I'm going to have to long with $5 billion. And within this, I have accumulated my long position. Now, currently, I would be in a long position until these shorts would want to, until I close it. So until I offload it to somebody who's looking too long. So now, this is how you can manipulate price. You just need enough money. This just proves that if you have enough money, you can move price wherever you want. Now, let's just say there was a richer player than me. If there was a richer player than me, then as I would be buying out the supply, he would notice that. And what he would do instead is initially it would go up a little bit, let's just say. Now he would notice that. Now he's going to be offering me shorts. He's going to consistently offer me shorts, say at this price. At the price he doesn't want it to go above. So let's just say he doesn't want it to go above this because there's supply here that he does not want me to interact with. What he's going to do is he's going to offer me the supply over here at this price. And no matter how much I buy, price is not going to go above this point unless he runs out of money. So now it's just going to be a competition. Who runs out of money first? Let's just say I ran out of money first. Now I'm at his mercy. So now if he can drop price down to here if he wants. He can drop down price even to 0. That's also possible. That happened on crude oil. If you guys take a look, that happened on crude oil. Price went to precisely 0. He can even drop it to 0 if he wants. The way he does that is he sells a contract for $0 and the price will be at $0. Okay? This is how you can manipulate price. Do you guys understand? Was I clear? Okay, I will give a quick recap. So if I want to move price from say $1 to $3, I simply need enough money to buy out all of the supply between $1 and $3, and I need enough money to buy out any potential supply that will be introduced as price moves up. So if as price moves up, there's more supply coming in, I need to have enough money to cover that. I need to have enough money to override that supply. So I need to have enough money to absorb that. So assuming I have all of that, then I can manipulate price wherever I want, to wherever I want, whenever I want, because there's no competition. I have a monopoly, pretty much. Okay? That is how you can manipulate, anyone can manipulate price, assuming they have enough money. And unfortunately, there's only one entity which can manipulate price, and we don't know exactly who that is, but we can make some speculations, but I'm not going to get into that. So there's only one entity, we're going to call them the elites. And these are the only people who can manipulate price. Nobody else can, because if anybody else tries to, then they will just capitalize on them. Okay? This is why all the ultra wealthy players need to either work in coordination with the elites or not at all. Okay? Now we can move on to the next division.